Good afternoon and good evening to our friends in Europe. Welcome to the Global Interdependence Center Executive Briefing. I'm Bill Kennedy, your host. This is our 7th edition of our Analyzing Pandemic series. Today we will look towards Europe, where roughly 40% of global COVID-19 cases have been reported, and we will focus today on how the pandemic and the policy response is impacting the European economy. Today's event is being recorded. The replay and the slides will be available on the GIC website later today. Now, typically, we would start our program with a quick audience survey. However, we have a lot of material to cover today, and out of respect for everyone's time, the audience poll will be held at the end of the program. So following the Q&A, as you log off, you'll be prompted to complete the survey. It'll take only about a minute, and we encourage your response and your feedback. So now let's get to our speakers. Debora Revoltella is the chief economist at the European Investment Bank, where she's been since 2011, and she and her team provide impact-driven economic analysis to the EIB. Debora holds an undergraduate and master's degree in economics from Bocconi University and earned her PhD in economics from the University of Ancona in Italy. And today, Debora joins us from Luxembourg. Alvaro Pereira is the Director of Country Studies branch at the Economics Department of the OECD. It's a role he has had since 2014, where he and his team oversee the famed country economic surveys. And prior to the OECD, Alvaro served as Minister of Economy and Employment in Portugal. Alvaro is based in Paris, but is joining us today from Portugal. And we're very fortunate and grateful to have these two excellent economists joining the GIC today for the executive briefing. So Debora, Alvaro, welcome to you both. Debora, you get to go first, so I'm going to turn the screen over to you.
Thank you very much, and it's a real honor to be part of this debate and to bring an European perspective and reading on the COVID economic crisis in Europe, on the European policy response so far, and on the long-term renaming concern and structural issues that we still need to address. In the next 15 minutes, what I wanted to pass as a message is that it's true the crisis is hitting very hard Europe today. There is still uncertainty, but the baseline scenario we have is that what we see after a very sharp drop of economic activity this year, we will see normalization going back quite slowly with a U-shaped scenarios and full recovery in 2022-2023. But the message I want to pass is that on the policy response, what we are seeing is that piece by piece, the policy response is coming, is already there to address the immediate liquidity crisis, and I will put the accent of the necessary steps that are still needed to have also the full response on the structural recovery phase. If we go to the next slide, I will start with analysis of the economic crisis in Europe. And the next slide is just setting the stage. What we have seen as a China story at the beginning has been quickly reverted to being a world pandemic. And by the end of February 2020, countries that represent some 80% of world GDP are in some form of lockdown. And by now we all know that COVID and lockdown are part of the same issue with the economic consequence of lockdown weighting very strongly on the economy. The economic shock is kind of easier to identify for economists like us. We see the impact of the demand shock, the supply shock, the trade collapse, and also the structural challenge related to re-questioning of the global value chain model. But the huge uncertainty are those that create much more concern in terms of our forecasting capabilities, On the one side is the medical uncertainty. We don't know about immunization, timing for a vaccine, the second round of contagion possible once the lockdown is unveiled. So a number of uncertainty that are really related to the medical element and are very difficult to be put in our model. The second kind of uncertainty comes on the shape of the recovery, and is strongly depending on the effectiveness of the policy answer and the consequent likelihood and severity of a second round effect of the crisis. And then the long-term structural change that this very specific crisis will lead to in terms of changing the individual preference, labor market, value chains, security, and also rule of the state in the economy. And I think these elements of uncertainty are something important that we have to figure out in the moment in which we try to understand the unveiling of the crisis and the policy response. If we go to the next slide, the immediate impact is clear. I think we have all seen the dynamic in terms of GDP growth. We have seen the very strong 3.5% contraction in Q1 that if annualized would give to a minus 14.4% growth in the first, at the beginning of the year. Our coincident indicator is also following the short-term dynamics, and we have a coincident indicator analysis for Germany, Italy, Spain, France, and we see the very strong contraction that is mirrored in all of the EU countries. In terms of sectors, looking at the economic sentiment indicator expectations, what we see is that what started to be a concentrated crisis affecting some sector more than other is actually now quite widespread all over the economy. The Commission just came out with the forecast pointing for a minus 7.5% growth in 2020, with a recovery in 6% in 21, but also, as I was saying, before coming back to the level of GDP of the pre-crisis period, we will have still more time to come. Going to the next slide. Some sign of stabilization we start seeing if we look at the data of contagion, and what most important, what we see at this level in Europe is gradual reopening from the lockdown across countries. We have some indicators. Still, I recall what I was saying in the beginning, the uncertainty related to the medical element is important. We don't know whether this unveiling of lockdowns may reinitiate new phases of contagion diffusion. Going to the next slide. The key question is on the shape of the recovery at this point. I think the baseline scenario is now turning for all analysts toward a U-shaped scenario, the V-shape. Actually, the very strong rebound and going back to pre-crisis level is not anymore in the baseline, I think, of almost all the analysts. The point of the U-shaped scenario is associated to some second round effect from the crisis kicking in, despite the effect of the policy intervention that we see. And it's very important to analyze at the macro level to see the intensity of this second round effect coming in, and then distinguish between the probability of a U-shape and an L-shaped scenario. I think in our baseline we have clearly a U-shape, not an L-shape, and we think that there are elements for the policy response to be strong enough to guarantee the exit from a U-shape, but not from a V-shape. Going to the next slide. I enter on the different sector, and actually I will look at the banking sector, the corporate sector, and the labor market to discuss this probability and possibility and the vulnerability, if you want, of potential second round effect of the crisis, and then also the probability of the U-shaped scenario. Starting from the banking sector, and here compared to the 2008-2009 crisis, this crisis is a crisis coming from the real economy, not from the banking sector. The banking sector started the crisis with much stronger capitalization than in 2008-2009. And we have a number of measures that have been put in place quite rapidly at the European level to create the capacity for the banking sector to continue to operate. We have seen guaranteeing of LTRO and TLTRO for long-term funding to the banks. Flexible use of existing capital buffer has been allowed, limited procyclical assumption in loan loss provisioning, blockage of dividend and share buyback, and then a number of measures at the member states to put in place a credit guarantee scheme to guarantee the portfolio of loans, the new portfolio of loans, in order to keep the credit channel going. So on the short term, the banking sector should be able to continue performance, but two possible risks remain related to the medium term, and mostly related clearly to eventual second round effect in terms of non-performing loans and the sovereign bank nexus that may remain remains a challenge at the European level. If we go to the next slide. On the corporate sector, we have been working on a database of some 2 million firms at the European level, looking at the balance sheet and trying to understand how much sensitive are European companies in terms of liquidity shortfall. So we have done a number of estimates with 4 different scenarios, looking at collapsing revenues and then fixed costs that remain for the firms to be paid, and then policy support that counts on giving waiver and grace period of payment on certain costs. With a scenario of lockdown that remains over time, what we see, and that even with the policy support that allows some grace period in repaying some of the cost, we can have up to 50% of firms after 3 months that may enter into liquidity shortfall. So the liquidity issue seems to be a quite important element affecting a big share of the corporate in Europe. This is clearly more so for the small and medium enterprises. The large corporate are entering this crisis with solid cushion in terms of liquidity and still access to financing on the bond market. We see particularly for startup and scaling up firms issues with the freeze of the venture capital and private equity market that creates issues for a market that was just starting to become a mature market at the European level. And we see issues with the security of the global value chain for some of the firms. If we go to the next slide, the last micro picture that I have is on the labor market. And here the situation so far, what we see is an impact on the labor market that is assumed to have an impact only on the short term. And what we see different from past crises, here the data are actually from the OECD, the sources, the sources should recognize it. What is interesting is that compared to past crises, we have seen in many countries the adoption of these schemes of short-term work scheme that offer some stronger protection in the labor market compared to what we used to have. The part of the European response is also helping a member state to finance this kind of programs. But if we go to the next slide, on the labor market, what is interesting is that the effect that we will see is going to be kind of differentiated across countries and differentiated across regions throughout Europe. The second graph shows an interesting analysis that we have been developing. We are looking at Google data of queries related to word related to unemployment, and we look at queries, so this sense of insecurity for the job that brings people to look for words related to unemployment. And what we see is that seems to be much stronger effect in a region that are where the internet use is lower. They tend to have a much stronger insecurity for job. Also regions that have a lower upper education in the population and no lower ICT jobs. So we see some differentiation in the impact on the labor market and the feeling of job insecurity that is important to be addressed on a European perspective. If we go to the next slide, I will quickly look at the policy response in Europe. I have in the next slide a quick picture of what is coming. For somebody looking from out of Europe at the European policy response, is difficult to understand. It's a sum of different players acting to address the policy needs. But at the end, the answer is coming for sure for the first liquidity crisis, and we have expectation and we see movement also on the recovery and policy potential growth side, but that's the second phase of the answer that we still need to be implemented. On the liquidity crisis, what we are seeing are a number of measures by member states. These at the European level are made possible by a decision by the Council for allowing flexibility on the Growing Stability Pact and the stated rule at the European level. This decision has allowed the member state to enhance their deficit in the short term and intervene in the market as needed in the EU member state, in each EU member state. Emergency spending has been approved by almost all countries for the health sector, and then a number of measures for delaying payments and taxes for individual, corporate, social insurance for individual and corporate, and guarantee schemes. At the European level, at the same time, we see the ECB intervention with quantitative easing policies. We see the support on the banking sector that I was mentioning before, and we also see three measures that are being now discussed. And if we go to the next slide, I can show also the number. These three schemes are the European response on the liquidity side. On the one side, the opportunity for DSM, the European Stability Mechanism, to lend to member states in the euro area to support expenditure related to the health sector. SURE is a mechanism put in place by the Commission, some 100 billion to support these labor market schemes, supporting individual, and the EIB is working on putting in place a guarantee fund to support corporate for up to 200 billion. With all of this, we see a very strong response on the liquidity side coming, with the second element important to be added on top of the ECB movement seen so far is more support for the recovery phase coming from the multi-annual financial framework, the budget of the EU and the Commission. If we go to the next slide, and I'm aware that I am short in time, One part of concern is related to the long-term risk, and particularly the sovereign debt risk at the European level. For sure, what we have seen is a massive increase in public expenditure to counter the crisis. This is also going to have an impact on debt of the EU member states. Here we see the forecast from the Commission that take into account the new proposed measures for end of 2020 debt to GDP, and still the cost of financing for the sovereign that is very much kept under control exactly through the measure put in place from the ECB side and the European response with the different option now allowed. With a back of the envelope analysis, we can see that almost all the increase in debt of member state can be financed through usage of the programs that have been put in place so far. If we go to the next slide, actually the next, I just want to put one notion. I think this is something is a slide that I'm using in all presentation, and I was using in all presentation much before the COVID crisis kicked in. Europe has some structural issues, important structural priority to deal with: competitiveness, productivity, social sustainability, environmental sustainability. The policy response to COVID requires clearly a very quick action, but the incentive has been put in place in order to keep addressing the short-term emergency, also in line with addressing the long-term challenge for Europe. And with that, I go to my last slide for the conclusion. Just mentioning, summarizing my message, we are talking about the deepest economic crisis since the Great Depression. There is a lot of uncertainty remaining, the medical, the shape of the recovery, and the long-term change that the crisis will lead. But we see a policy response that is coming definitely on the liquidity side, and is coming at the European level. And we need to see the implementation of the recovery part of the policy response that should also look at tackling the long-term structural challenge. Thank you very much.
Oh, that's great, Debora. Thank you very much for your comments. We're going to bring Alvaro on while we're getting his camera prepared. Let me ask one clarifying question. I think I heard you say that the European Commission forecast for real GDP in the euro area for 2020 was minus 7.5%. Is that accurate?
Yes.
Okay, so that's consistent with IMF's forecast as well for 2020. Okay, excellent. So Alvaro, we'll turn it over to you, and look forward to your remarks, and Debora will have you back for Q&A.
Hello, good morning, everyone, or good afternoon, wherever you are. I should start by saying that I'll come back to the conclusion. I will not talk about forecasts. We follow about 50 countries, from New Zealand to China to Japan to Latin America and so on. And our forecast will come on the 10th of June. And I can tell you that we will be more negative than the European Commission and the fund. In fact, the fund, even yesterday, they were saying that the V recovery is not happening, and I'll come back to this, but we are not so positive. Well, if you can call the fund forecast positive, well, I can tell you that certainly they are a bit more optimistic than we are, and I'll explain in my presentation a little bit, and then obviously you can, in terms of questions, you can ask me a little bit more about that. But I'll talk about the economic consequences and policy response to the pandemic in Europe. Next slide, please. And basically, we know that the shocks of the pandemic and the confinement has varied quite a lot across countries, and we got some estimates of how much there are. And this is usually the effect has to do with the strictness of the confinement measures. we know that there's been a very strong policy response from countries, and I'll debate a little bit about what Europe has done, and I'll say, well, basically, this is very different from 2011, 2012, when there was the European sovereign crisis, but also something that I think is going to be very important for Europe and other parts of the world is the liquidity crisis that is brewing, and that will lead to almost likely to a rise in insolvencies in many countries, and might lead to what some economists call capital scraping. So which basically some firms will go bust, and we will lose some part of their capital, unfortunately. But we'll come back to that later. Okay, so if you could see the next slide. So after the pandemic, remember, this pandemic, I think the best analogy you can have is the 1918 pandemic, but the problem is 1918, which lasted 2 years until 1920. But the 1918 pandemic, the problem was the end of the First World War, and the First World War, in fact, contributed to the pandemic. And so this is why there's not a lot of analysis regarding the pandemic, but we can draw some lessons. Here, this graph basically is telling you what different countries, G20 countries and OECD countries are doing in terms of lockdown. So it aggregates basically what countries are doing. Just to give you an idea, in terms of we have 22% of the countries right now, G20 and OECD. OECD is 37 countries plus, and some G20, of course. We're talking about 22% of those countries have a nationwide lockdown. Others have different types of confinement measures. You can see that on the right, I will tell you what is the impact on the economic activity. I will not go through that because I think that you can see that afterwards if you want. But if I can see the next slide. We know that this is an unprecedented crisis in many ways, and the most striking graphs that I've seen, and I think we all have seen, is exactly these PMI indices or other business indicators or economic activity indicators in which things just plunged, right? So, and you can see this is in Europe at least, and other parts of the world as well. For the PMIs, the service PMIs have went down a lot more than the manufacturing PMIs, partly because services were shut down a lot more than manufacturing. And so this has some consequences, especially for countries that are highly reliant on services like tourism, but also other types of services. If you go to the next slide, the OECD has looked at basically the impact. We try to estimate by sector using a sectoral analysis. We try to estimate the impact of the shutdown in several economies. This is basically for a lot of G20 countries, and you can see that the impact basically of the shutdown is projected decline is between 25% in Italy to about 5% in Korea, because Korea was a lot more less strict in terms of confinement. Next slide, please. And in terms of the euro area, you'll see that countries like Greece, in which the impact of this lockdown is fairly dramatic, they've done extremely well, the Greeks, in terms of staving off the worst of the health crisis. But they have a huge tourism sector, and because of the legacies of the past, we assume that, or we estimate they're going to be highly affected. But you can see countries like Germany or Spain and a few others, in which the impact is going to be fairly large. If you go to the next slide. And what we also estimated so far is exactly what will happen in terms of liquidity. And we estimated how severe is this liquidity crisis going to, how severe is this crisis going to happen. And obviously, the longer is the lockdown, or if there's another lockdown, then the worst is going to be in terms of liquidity. But just to give you an idea, after 3 months of lockdown, basically you might have 30 or 40% of firms in some countries with liquidity issues. And so unless the government measures that are already in place or new measures will come into being, unless this happens, these firms will go bust, and which will lead to a substantial impact on the economy. If you go to the next slide, this just to give you an idea. The next slide, basically, I don't want to give you a lot of insider. I will not give you a lot of insider hints of what our forecasts. I can tell you the forecasts have been the most challenging we've done so far. I think this is true for everyone, mostly because we have extreme uncertainty. We don't know if the virus is coming back. So, and we don't know how many scenarios you're going to have on the table. We will have quite a few scenarios to deal with. But just to give an idea, at the OECD, we're thinking our main scenarios are going to be two. We're going to have, as Debora was talking about, we're going to have a scenario of a kind of a Nike swoosh type of recovery. So it's a V, but it's kind of it's not a very sharp recovery. And the other one is looking at what happened to previous pandemics in the 20th century and the 19th century. We know these things comes in waves. And perhaps we're not even experiencing the first wave. It might be, we believe, and we are assuming, this will be flu season around September, October, or November. And when this happens, that means that perhaps countries will hopefully be a lot more ready than they were this time around. But they will still be restricted movements, or some sectors might close down. Parts of the countries might close down. So we believe that this could almost likely lead to a double dip type of scenario. So one scenario that we have is, right now not recovering very fast, and will recover a little bit more. But then the possibility will be a second wave of the pandemic, which obviously have an impact on GDP and all the other variables. And just to give an idea of all the countries we follow, I don't remember that we were so gloomy in terms of our forecast. The first scenario, which is as I said, a kind of a U type of scenario, is already gloomy. But the second scenario, which we think that is probably the most likely one, is even gloomier. So we're talking about, in several countries, negative growth of -10, -15, which is fairly unprecedented, and especially in peace times. And it's not a pretty picture. But when you do forecasts, like perhaps some of you are doing forecasts, when you do forecasts, right now it's we don't know what will happen, and not only the scenario issue is at stake, but also how many revisions should we do. We've done forecasts for the G20 in March. Totally, we're already very negative compared to anybody. But right now we realize that we were way too positive at the time because we did not have enough information. And perhaps, well, the fund right now is saying that probably they were too optimistic when they did their forecast, and that's why they had 5 scenarios, in fact. But the central one was the V one, and almost likely we'll have to revise our scenarios down the line. So if you go to the next slide, what is different between this crisis and the previous ones? Well, usually a typical crisis, it comes either because of structural problems, excessive debts, or poor investment or policy mistakes. Whereas now is a crisis that we haven't seen, at least for many years, many decades, in fact, which is an exogenous shock that affects everyone, and which the IMF, for example, is assuming that 90% of the world economies will have negative income per capita growth. This is unprecedented, no doubt about it, and it means that in almost every single country of the world, people are going to have less income. Less income will mean certainly less consumption. And as we know from macroeconomics, we are going to have a lot less investment. So I think these are the things that will happen for sure. And this will lead to a substantial rise in unemployment. I won't go through all this, so I'll try to focus a little bit on Europe. So what has been the policy response of Europe? If you go to the next slide, please. And the following one. So if you could follow, yes, please. Thank you very much. What are policy responses? So just to put things into perspective, the policy response of the European Union this time around has been very, very different from the 2010-2011 policy response for a variety of reasons. The crisis in 2010-2011 was basically a very asymmetric shock, or asymmetric crisis in which you have a few countries that had a lot of imbalances, debt built up, bad policy choices, and the rest of the European Union was doing fine. And so the policy response was, okay, these guys misbehaved, so now they have to readjust. And some people thought that they had to pay a price for that. And so there was the Troika programs, adjustment programs, all austerity that was into place. This time around is totally different, of course. And in fact, while in 2011, the big change compared to now was the ECB. The ECB decided to maintain, first even to raise rates, but then to maintain rates, not to take into account or undertake an expansionary monetary policy. This time around, the ECB did exactly the opposite. Rather than waiting 2 or 3 years to see if things were working out or now, right now they brought all the guns, like the Fed, and tried to bring a lot of support for bank lending and liquidity. So this is a huge change. I will not go through all these the things that Debora has already mentioned as well, but it's a totally different ballgame in terms of the ECB and in terms of monetary policy in Europe. If you go to the next slide, in terms of prudential regulation, also there's been very different type of measures and very different policy response from what happened in 2011, 2012. Right now, even measures to temporary capital relief to banks were introduced, whereas the opposite took place a few years ago. If you go to the next slide. In terms of fiscal policy, this is something that obviously this is the big discussion in Europe. Right now, people are thinking, well, should Europe issue the so-called Corona bonds? What should they do? Well, Europe has already undertaken two measures that I think are quite important compared to, again, what happened in the past. First of all, they are allowing the constraints on national fiscal policies, which means that instead of having a mandate that you have to have a deficit lower than 3% of GDP, right now that requirement was lifted. And more importantly, or as importantly, but it doesn't get as much press coverage, state aid rules. So there's a waiver of state aid rules, which means that suppose that you have an aviation company right now in big trouble. If you were in Greece or in Portugal or in Spain in 2011, 2012, and you wanted to capitalize or help to bring capital into an aviation company, an airline, you could not. It would go against the state aid rules of the European Commission, and they would block you. So if you wanted to help not only aviation but other sectors, and at the time of the financial crisis, this was not possible. Right now, this is totally possible. So this is a totally different ballgame for many countries in Europe, and in fact, the Germans and the French and a few others have already used this temporary exemption of the state aid rules to help their companies, and almost likely, potentially even to nationalize some of the companies. Many other things have already come into place, and I think Debora has done a fantastic job, so I will not go through all of them. So if you could go to the next slide. And in fact, I would ask you to switch to the following one, please. You can, again, the slides will be available so you can read them afterwards. But more importantly is, what is the next step of the European Union? Perhaps this is what you are more interested in. So there's a big debate what to do. So there's two or three possibilities. There is one that has been for sure right now discussed, which is that recovery fund. And so potentially the European Commission issuing some debt and then allowing for a kind of not a Marshall Plan type of thing, but a recovery fund to help countries recover around Europe. So they seem to be preparing this for the next European Council, which will be soon. And it might take a bit longer, but almost likely this recovery fund will happen. The question is, how big will this be, and what type of conditions will countries can use in order to access this recovery fund? But it might be done, might be used to do infrastructure type of funding, both at the European level and at the national level, and so on and so on. The other two possibilities that Europeans have is to either to mutualize the fiscal cost. So could be Corona bonds, or could be something else. This politically is very difficult in several countries, especially in Germany, but also in Holland and in some of the Eastern European countries. And the other possibility that could be used is to use the European Stability Mechanism, the ESM, and beef it up, but water down their conditionality. So the ESM was built for countries that are in trouble, and the ESM was basically could be only for the Greeks of the world, if you can put it that way. But right now, everybody, or quite a few countries, are the Greeks of the world as well. So the ESM potentially, as long as the conditionality is waived, or at least if there's only conditionality, the conditionality is you cannot use the ESM funding to finance past debt or legacy debt, and you can only do this to help out right now the pandemic response, then it's possible that the ESM could be used. So I believe that potentially in the future, after the recovery fund, down the line when things are worked out, and we'll see what the crisis will lead us, it's very likely that this is the option that Europeans will go through and will decide to go to. So basically, a beefed up ESM with conditionality waved down, or at least watered down, and so allowing some countries like Italy that will see the huge increase in debt, being able to finance things at a reasonable rate. Okay, so just to wrap up, I believe that certainly the policy response this time around has been is much better than in the past, but it's not enough. If Italy, as some people forecast, Italy will end up with debts of around 150, 160% of GDP or higher. Greece above 200%, and a few others close to 130, 140%. It's very likely that they will want to ensure that they'll be able to finance themselves for a few years. And so this is why the policy response at the European level is so important. But anyway, there are several options on the table. Happy to discuss them with you. Thank you.
Thank you, Alvaro. Very, very excellent presentation. So we're going to bring Debora back online, and we're going to move to the Q&A portion of the program. Just as a reminder, if you would like to ask a question on the GoToWebinar page, there's a dashboard to the right. Go to the tab titled Questions. You can type in your question. That'll put it into the queue, and we'll put those to Debora and Alvaro. While we're waiting for the questions to come in, I do have a starting question. And this question is, what is the pandemic's impact on the UK-EU dynamic in the short and medium term? And specifically, are we still on schedule for a hard Brexit, or is there a possibility that the process might be altered? So Debora or Alvaro, I don't know which of you would like to take that easy question.
I'm happy to leave it to Alvaro.
Okay. I sincerely think, obviously, certainly in terms of forecast, this is only complicating matters. If forecasting the British economy in the next 2 or 3 years was always very complicated, because our central scenario was that they will get some sort of an agreement. But obviously, the non-central scenario, there's no deal. Right now, it's even a lot more complicated. I sincerely think that it's premature. There'll be a lot of negotiations. I think it's premature to draw any kind of conclusion, to be honest with you. I do think that solidarity between European nations will have to happen, and so I think I'll leave it through that. But I think it's premature. If you ask me, probably in September, October, we'll know a little bit more. Right now, everybody is worried about the pandemic response, both at the health and the economic level. Having said that, negotiations have already started, right? So they started last week, and so it's very likely that they'll continue. But these are very complicated matters, and so it might take a bit longer. And so I would not be surprised at the end of the day, contrary to what the British at first asked or were planning to do, I would not be surprised that there'll be a longer period for negotiation rather than stopping at the end of this year. There's a good excuse, though, right now.
Great, thank you. Okay, we have a question here, equally easy. So Germany's constitutional court appears to have thrown down the gauntlet to the ECB regarding its quantitative easing policy. There's a sense here of the primacy of EU law versus national law. So could both of you or one of you just comment on your view about the Germany's constitutional court action? Debora, you want to take a shot?
Yes, those are very, very easy questions to ask to economists, because in this period we are asked to become expert of pandemics, we are asked to become expert in politics, and now also in law and constitutional laws. I think it's very complex as economists to give answer to that. I think the complexity of the decision is key. I think we enter into a debate concerning supremacy of EU law versus national law. And I think the answer at the European level has been very clear, both from the ECB side and from the European Court. And the action, I think the ECB is committed to continue the operation that is pursuing. And I think it will be something where there will be a lot of legal debate going forward, and it's very difficult. But I think economically, I hope we will not see the consequences.
Well, if I may add, I do think that if European law is not above national law, then the European Union should not exist. So I do think that if European countries want to continue to have the European project, which I think they will, and they do, I do think that European law will win and will be superseding the national law, which means that in this case, the European institutions, including the courts, will take precedent with regards to the national courts. So that's, I think, that will have to happen. Otherwise, there's no European project anymore.
Great, thank you for your response. A question for Debora. Do you think that the pandemic will bring more of a fiscal consensus among member states? Or so more consensus around fiscal policy of the member states?
I think at the European level, it's always the policy reaction always requires a lot of dialogue, and everybody stays in its own position. There is a lot of discussion, but then there are movements. What we have seen and what we are still seeing in those days, it's quite interesting because we have seen the immediate, I think both me and Alvaro, we were showing it. When you, immediately after the crisis, the first very important move has been the allowing the flexibility of the Growth Stability Pact and allowing the flexibility in the state aid rules. For a European perspective, this is a very strong move to allow member states for an expansionary fiscal policy as much as needed in the country. And then after this first step that has been extremely important, there has been a long negotiation that is going on since more than a month and a half now on the European response to the liquidity crisis, with the three elements in it: the rule of the ESM, the rule of this sure mechanism implemented by the Commission for the labour market, and the EIB package to support corporate. In the negotiation of these three elements, we are still pending the final agreement. Actually, the ESM was supposed to be the most difficult to negotiate, to get an agreement. It has been the first one approved, where member states got an agreement on something very difficult, to use the ESM for something that is for expenditure on the health sector, so for something that is like without conditionalities, kind of twisting a little bit the way in which you use the system. But it has been used and it has been approved. The second point of sure, as well, there was a lot of discussion among member states in trying to find the agreement of using the possibility of the Commission of issuing bonds for financing something on the labour market, and it has been agreed with different views converging on the mechanism and on the details, on the temporary nature. A lot of discussion has been taking place. And the last element that we see is also on the mechanism for the companies, for the providing liquidity to the companies through the EIB. On that one, we are still pending the final decision because the discussion is on some technical details. And in the technical details, the discussion on the technical details, you see the view of member states that still diverge, but try to find an agreement. And we are seeing it. So we see the most difficult implemented. We saw sure now is passed. The final decision is passed for tacit procedure among the member states. That means that we are almost there. And also for the EIB mechanism, we see that the agreement is coming. So it's quite interesting to see that it's slow, but the decision-making process is coming, and there is some more cohesion of a member state in trying to find the single European response. Then, if I have to conclude, I also say that there are still very strong entrenched views in member states on the rule of deficit, the black Schwarz, as you say, etc. So the conviction still stays there, but there is a very strong willingness to find a compromise final solution.
Great, thank you for that. Alvaro, two questions for you. One was a clarification. I think it was slide 5 in your deck where you're showing the fourth quarter data versus the second quarter of 2020. Were those numbers annualized?
Yeah, I think so, yeah.
Okay. And then a follow-up question for you. Which will have a worsened economic environment, the EU or the US?
Both are not pretty with you. Our forecasts for the United States are not so rosy. I really think it depends also which type of country you're talking about in the EU. Some countries, the contraction is going to be around 5 to 6, 7%. In the United States, we are not so positive as well. So in other parts of Europe, it's going to be minus 13, minus 14. So it depends. I do think that the big advantage that Europeans have, it's disadvantage in many ways, but it's compared to the United States is the unemployment. You know, we're talking about 33 million people already in the United States and unemployment. Of course, we expect that after when this is over, the hiring will be much faster. But remember what happened in the last crisis in the United States, participation rates went down fairly dramatically as well. And this is happening already. So people are getting discouraged, they're getting out of the labor market, and it's definitely a problem. I do think that there will be other packages besides what we've seen so far. There will be almost likely other packages, especially to help people to support them if they become unemployed and if they become long-term unemployed. In Europe, the unemployment problem is not so severe, partly because of short work schemes and partly because of the social security that social services that we have there. So there'll still be a big increase in unemployment in countries like Italy or Spain and a few other countries, but it's not going to be as severe as the United States. So it's difficult to say what is going to be prettier, the United States or Europe. It depends on the perspective. I do think that both in the United States and in Europe, you're going to see a big increase in insolvencies. Not now, but probably 2 or 3 months down the line, especially in some sectors that are going to continue to be affected by a lack of confidence in consumption. If you think about tourism, you know, it's not only the restrictions, but basically we are not going to travel as much in the foreseeable future. Most people are not going to travel as much as we used to. The same thing for restaurants, and the same thing for many other real estate and a few other services, which will be affected. And so I think this is happening in the United States, it will happen in Europe. And so I would not be surprised that you'll see dedicated programs to try to help out these most affected sectors.
Okay, thank you. Debora, this question is for you. Can you tell us a little about what's new in the EIB's lending and guarantee program for the pandemic?
Yes, so the European Guarantee Fund is the way in which we call this pandemic effort, is a request to member states to provide a 25 billion guarantee that will enhance the EIB group capacity to produce to support companies in the course of the crisis, to alleviate the liquidity concern for firms. And the total impact of the activities of the EIB will be an enhancing an increase of activities with impact on the market for 200 billion euro, up to 200 billion euro. So the kind of product that we are going to provide are products targeted to very quickly support the liquidity of particularly small and medium enterprises. And mostly they go in the direction of providing a guarantee to the national guarantee, counter-guaranteeing the national guarantee schemes that have been put in place by member states. So basically we provide a AAA guarantee behind the guarantee provided by the national guarantee schemes. Also, we will deal directly with commercial bank and provide guarantees to new portfolios of loans that these commercial bank put in place to support lending to the SME. And then we will also support we will continue to support the liquidity in the venture capital market, where actually we as an institution have a very strong role. Something that is not well known is that the EIB group is a minority investor in funds of funds, and is a fund of funds per se, and is a minority investor in funds that represent almost some 50% of the venture capital market in Europe. So on the venture capital, we are particularly interested because the market was a maturing market, was starting to become a mature market in Europe, has been lagging behind the market in the US. Innovation is so important, and we see the risk that the crisis may kill part of the innovation capacity of Europe if this venture capital is not supported. So it's one of the elements that we are looking at.
Great. So we have time for two more questions, and I want this question, Debora. It carries on to what you just said about innovation. So as we see these adjustments in fiscal policy, can you speak to the impact on technology and scientific innovation in both the public and private sectors? Is there anything in the fiscal stimulus that we've seen thus far directed towards healthcare, science, technology?
Yes, I think there is a very strong focus, both for sure at the EIB side and also at the Commission side, in terms of keeping the innovative companies, and particularly part of the effort is really to keep the innovation capacity of Europe with a startup, with a very innovative company, to keep the funding going and to avoid that the liquidity crisis will affect those companies. We have started on our side, it's not a part of the pandemic exercise, but it's part of the immediate reaction to the crisis with no additional support or something. We have been looking at all the companies, the innovation companies that we were already supporting, and we have been assessing whether they had the immediate liquidity need, and we were trying to find a quick way for supporting on the very fast liquidity need. And that's extremely important for the a new growing innovative company and with new activities. So this has been a very important element of our reaction.
Excellent. And Alvaro, the last word goes to you. So it's actually, it's a great question for economists. With COVID-19, there's a lot of focus on health data and pandemic medical related data. The question is, do you see the ability to forecast and economic measurements becoming more relevant as a result of COVID-19? So are you and your team finding a more relevant data points to reconnect daily business activity with economic forecasting?
That's a great question. Yes, we are. In fact, we are using a lot of micro data and we're using a lot of even, I think a lot of our institutions are using Google data to see tracking the movement of people. I just saw a paper, in fact, of that they were exactly trying to estimate the impact of the lockdown, and they were basically updating those impacts that were done usually generally remodel and so on, like we do, but they're doing this through the Google mobility people around the different countries. And we have this data available for us now, and really helping us in our forecast. In our forecast of the OECD, you'll see, when you see the economic outlook of the OECD, you'll see a combination of that and with traditional approaches. And we were not doing this. And so kind of an innovation in that way. I think this crisis is also bringing a lot of opportunities besides the data issue. We talk about a digital transition, well, the digital transition is here. It's not transition anymore. We are already in a digital world. And I think the crisis accelerated dramatically the digital transition, because basically from schools to the OECD to, you know, your institutions, we are right now doing stuff that were unthinkable a few months ago. Just to give an idea, I travel a lot because I follow 50 countries, and it's always a big burden, not only on the environment, big carbon footprint, but also on my family. And I've been trying to persuade my IT services, listen, I really want to do these digital missions, you know, remote missions and so on. They always say it's too complicated and so on and so on. Well, right now everybody is doing it, so no more excuses. So I really think this will also help us out. And so certainly we have fantastic seminars like this, or other issues we can use the web like we were not using before. And I think this is a great opportunity for us to innovate and to prosper in the future.
Yeah. And
well, completely agree. And on that very positive note, I want to thank Debora and Alvaro, thank both of you for very interesting and timely insights. So let me remind our audience of future programs, what you have to look forward to. On May 21st, next Thursday, the executive briefing will focus on pandemic's impact on small business in the United States. And that will be followed the following week on May 28th with a special discussion on central banking and the monetary policy response, featuring Dennis Lockhart, who is the former president of the Federal Reserve Bank of Atlanta and a fellow in the GIC's College of Central Bankers. So please join us during the next 2 Thursdays for the executive briefing. As a reminder, a replay of today's virtual event and the slides presented will be posted to the GIC's website. That's at www.interdependence.org. While you're on the website, you are encouraged to check out our membership options. And for a limited time, the GIC is offering a 10% discount for an annual membership. An annual membership tends to run about $200. So with the discount, you're paying for about $180 for some of the best policy and economic and market content available. And you will get the opportunity to attend GIC live events once they reopen. So please check it out when you're on the GIC website. We want to thank all of you for participating in our closing survey. And thank you very much for joining us today. Good evening and good afternoon.
thank you very much.